Hey everyone, my name is David Dalbero, and today we're going to dive into a hot topic that affects your wallet in more ways than one: federal interest rate cuts. Now, you might have heard something about the Fed lowering rates in the coming months, but what does it really mean for you when they cut rates? Let's break it down. When the Fed cuts interest rates, it essentially means that they're making it cheaper to borrow money, and this can have a big ripple effect across the economy. First, let's talk about mortgages. If you've been waiting to buy a home, a rate cut might be your golden moment. Lower interest rates can lead to cheaper mortgage payments, which means you might be able to afford that dream house you've had your eye on. If you already have a mortgage, refinancing could save you a ton of money over the years. But of course, there's a flip side. Lower rates often drive home prices up. With cheaper borrowing, more buyers enter the market, and this competition can cause home prices to surge. So while your monthly payment may be lower, the price you pay for the house might be much higher. Next up is your credit card and personal loans. With a rate cut, you can see lower interest rates on your credit cards, auto loans, and other types of personal loans. This means if you've got debt, especially high interest debt, a rate cut could help you pay it off faster because the interest charges won't build up as quickly. Also, this will allow for the opportunity to refinance to a lower rate on existing debt. But let's not get too comfortable. This also is the time when people feel most encouraged to take on new debt, and that can lead to a vicious cycle of overborrowing, which can bite you later if rates go back up. Next up is investments. This is where things get really interesting. Rate cuts often boost the stock market because lower rates make it cheaper for companies to borrow and expand. So if you have investments in stocks, you may see your portfolio grow. But here's a warning: while stocks might soar, short-term bonds and savings account interests will likely take a hit. So if you're someone who relies on interest-paying vehicles, you may want to reevaluate where you're putting your money in the future. Finally, let's touch on the big picture, the economy as a whole. Lower interest rates are designed to stimulate spending. If businesses can borrow more money cheaply, they might invest in growth, hire more employees, and pay higher wages. In short, this can boost the economy. But here's the kicker: when rates are too low for too long, it can lead to inflation, making everyday goods like groceries and gas more expensive, like what happened post-COVID. That being said, you can count on the Fed being very careful regarding the size and frequency of their coming rate cuts. So what should you do when the Fed cuts interest rates? Well, it's all about balance. Take advantage of the lower borrowing costs, but don't overextend yourself. If you're investing, it's a good time to reevaluate your portfolio. That's it for today, folks. If you found this helpful, hit the like button and don't forget to subscribe for more financial tips to keep your money working for you. Let me know in the comments how you will take advantage of a rate cut. Thanks for watching, and I'll see you next time.